Right now, HMRC is quietly taking more of your hard-earned money than they did 5 years ago, and they haven't raised a single tax rate to do it. It is called fiscal drag. Tax thresholds have been completely frozen since 2021 while wages and inflation have climbed. That means millions of UK taxpayers have been dragged into higher tax bands without a single pay rise actually making them wealthier. It is a silent tax increase that costs ordinary households thousands of pounds every single year. Here is the truth. The UK tax system is filled with legal, HMRC-approved allowances that allow you to claw that money straight back. These are not dodgy offshore schemes. They are official rules built into the law by Parliament. The catch? Most of these allowances operate on a strict use-it-or-lose-it basis. If you do not use them before the end of the tax year, they reset to zero and that allowance is gone forever. Before we walk through these 5 strategies, do yourself a huge favor. Hit the like button, share this with anyone in the UK paying too much tax, and subscribe to the Wealth Ledger right now. We publish direct, high-value financial breakdown strategies every single week, and subscribing ensures you never miss a deadline to protect your personal wealth. Let's dive straight into strategy number 1. The 60% tax trap. Most people assume the highest tax band in the UK is 40% or 45%. It isn't. If your net income falls between £100,000 and £125,140, you are trapped in the most punishing tax rate in the country. For every £2 you earn over £100,000, HMRC reduces your tax-free personal allowance by £1. When you combine the loss of that allowance with standard income tax and national insurance, your real effective tax rate jumps to an astonishing 60%. If you receive a £10,000 bonus in that bracket, you keep less than half of it. The legal solution is pension salary sacrifice. By making additional pension contributions or sacrificing part of your salary back down below the £100,000 mark, you instantly restore your full personal allowance. You legally erase that 60% tax charge, and every single pound saved goes directly into your pension pot where it grows completely tax-free for your future. Strategy number 2. Maximising your £20,000 ISA allowance and using BED and ISA. Every UK adult receives a £20,000 ISA allowance every single tax year. Inside an ISA, whether it is cash or stocks and shares, your money is shielded by a 0% rate on income tax, dividend tax, and capital gains tax. If you miss the April 5th deadline, that £20,000 allocation vanishes. It does not roll over. If you already have investments held outside an ISA, you are sitting on a growing tax liability. The smart play here is a BED and ISA maneuver. You sell your investments held in taxable accounts and immediately repurchase them inside your ISA wrapper using your annual allowance. While selling outside an ISA can trigger capital gains tax, executing this carefully within your annual allowances moves your portfolio into a permanently tax-free environment for life. Strategy number 3. Spousal asset shifting and allowance doubling. If you are married or in a civil partnership, you have one of the easiest tax-saving tools sitting inside your own home. Asset transfers between spouses are completely exempt from capital gains tax. This means you can instantly double your household protections. You get access to 2 £20,000 ISA allowances, giving your household £40,000 of tax-free investing power every year, alongside 2 separate capital gains tax exemptions. Even better, if one partner earns significantly less than the other, you can legally transfer income-producing assets, like rental properties or dividend-paying shares, into the lower earner's name. The income is then taxed at their lower tax band rather than your higher rate. Furthermore, if one spouse earns below the personal allowance threshold, you can utilize the marriage allowance to transfer £1,260 of unused allowance to the higher earner, instantly cutting your tax bill by up to £252 a year. Strategy number 4. Limited company director optimization. If you run a limited company or operate a profitable side business through a corporate structure, taking your earnings purely as a standard salary is a massive mistake. The most tax-efficient structure involves taking a low salary, typically set around the £12,570 personal allowance threshold, which maintains your state pension qualifying years without triggering high income taxes or employee national insurance. You then top up your personal income using dividends, which carry lower tax rates and zero national insurance. To unlock maximum efficiency, make direct employer pension contributions straight from your business bank account into your pension. Direct employer pension contributions are generally classed as an allowable business expense. This means the money bypasses corporation tax, bypasses personal income tax entirely, and enters your personal retirement fund completely intact. Strategy number 5. Capital gains tax planning and loss harvesting. Capital gains tax catches countless investors completely off guard. The annual tax-free allowance for capital gains has been slashed down to just £3,000 per person. To keep your tax bill at zero, you must manage your asset sales proactively. Instead of liquidating a large position all in one go and incurring a massive tax bill, spread your disposals over multiple tax years to use your £3,000 exemption repeatedly. If you hold investments that have fallen in value, do not ignore them. Use loss harvesting. By selling a loss-making investment, you legally register that loss with HMRC. You can then use those recorded losses to offset against taxable gains made elsewhere in the same tax year, or carry them forward indefinitely to cancel out future tax liabilities. To wrap up, tax planning is not about breaking rules, and it is certainly not reserved just for millionaires. It is about understanding the basic math of the UK tax system so you stop handing over cash you are legally allowed to keep. Escape the 60% trap through pension sacrifice. Use your full £20,000 ISA wrapper. Combine allowances with your spouse. Optimize your company withdrawals. And harvest your investment losses. These allowances are waiting for you right now, but they reset every year. Make sure to hit subscribe to the Wealth Ledger to stay ahead of every financial trick and tax rule change in the UK.